As I'm saying, I'm John Swolfs. I'm the co-founder of Advisor Circle and our head of content. I will be your host today, but I really see my role as getting out of the way and allowing our guests to do most of the talking. Today, we're going to be focused again on the macro outlook for 2023 and why this time is different. So with that, I'm hugely excited for our guest today. This is going to be a really fantastic in-depth webinar on the macro outlook, bringing tons of knowledge, tons of insight. So instead of hearing from me, why don't I go ahead and introduce you to our speaker. So our first guest today is Jay Pelosky. He's based in New York City. Jay wakes up every day excited to take on the twin challenges of understanding the global cross-asset markets and deploying analysis in an actionable, consistent, and world-class fashion. He embraces the challenge of making the complex simple across assets and countries, sectors and styles, factors and themes. A thought leader, Jay relishes peering into the near future and creating investment narratives like COVID speed and tech kryptonite. Jay spent the past decade developing the TPW framework of regional integration of the three main regions of Asia, Europe, and the Americas. Developed over the past 5 years, the GRN system analyzes the interplay between economics, politics, policy, and the markets on both a regional and global basis. Together, they form a unique global investment process available only to TPW advisory clients. The former top-ranked head of global asset allocation at Morgan Stanley, Jay has decades of experience advising clients ranging from DIY investors to high net worth individuals, hedge funds, ETF strategies, corporates, and RIAs. I think the most important thing, though, is Jay eats his own cooking. For the past 20 years, he's been investing where he puts his money where his mouth is. If you like what you hear from Jay today, which I know you will, you can check out his Friday's musings, which I read on a weekly basis at pelosky.com/musings, where you can also sign up to have those sent to you on a weekly basis. Alongside Jay, we have Marta Norton, who is the Chief Investment Officer for Morningstar Wealth. She oversees the Americas investment team, working with advisors and institutions to help develop investment offerings to investors. Marta is a member of the Global Investment Policy Committee, which directs the unit's global investment capabilities, commitments, and processes. She is a named portfolio manager on the Morningstar Global Opportunistic Equity Fund, the Morningstar Global Income Fund, and the Morningstar Alternatives Fund. Before assuming the position of Chief Investment Officer of the Americas, Marta was a portfolio manager and the head of U.S. outcome-based strategies team. In 2008, she joined the investment management team from Morningstar Inc.'s management research team. And before that, she was working at the Bureau of Labor and Statistics. As you can see, we have a wealth of knowledge joining us today. But in addition, we are joined by my co-host and the straw that stirs the drink, Barry Ritholtz. For those of you joining us today who may not know Barry, he's the co-founder, chairman, and chief investment officer of Ritholtz Wealth Management, LLC. That firm launched in 2003. RWM is a financial planning and asset management firm with over $3 billion in AUM. His firm is on the Financial Times top 300 advisors in the US and is the fourth fastest growing RIA in America. His career history is filled with cutting edge innovation and new ideas. He is one of the earliest traders to embrace behavioral economics, and he created one of the first and most popular market blogs. His podcast was groundbreaking and among the earliest in the investment space. He's been named to one of the 15 most important economic journalists in the United States. He's been called one of the 25 most dangerous people in financial media. I would recommend that you check out his blog, The Big Picture. So a nice, happy welcome to Jay, Marta, and Barry. I'm excited to dig into today's topic. Again, that's the macro outlook for 2023, why this time is different. I know you've heard a lot from me already. And as I said at the outset, I want to get out of the way and allow our guests to go ahead and get on with the conversation today. So the first question, and this one's going to go out to Marta, but again, we hope this is conversation for everyone. The last year was the third worst year for returns in the past 100 years. Before we get into the finer details on the markets, I think we should start by sharing the overall view of the markets and how you see 2023 playing out. Marta, what are your thoughts?
Yeah, I'll certainly kick things off. And John, thanks for having me. It's great to be with everyone today. So as we think about 2023, I think it's really hard to sink our teeth into it without first talking about 2022. And so just to give you some background, when we were entering 2022, our investment team was about as conservatively positioned as we could be, whether it was in equities or in fixed income. We were nervous about valuations across the board. We certainly didn't anticipate a war in Ukraine. We didn't anticipate how the rate cycle or inflation movements would play out, but we were concerned about where valuations were. And so as we see this tremendous sell-off that we saw last year, whether we're talking about fixed income or whether we're talking about equities here in the US or overseas, it was an opportunity for us to get more interested in the market. So as we sit in 2023, I think we're more optimistic than we've been for quite some time. And that's, again, valuation rooted. We see far better yields across fixed income markets, and we see much better equity valuations. But that said, if we're looking just at broad equities, broad fixed income, we'd say it's just under fair value. We think there's pockets of opportunity, and I'm sure we'll touch on that. Areas like China are interesting to us. Areas like Germany are interesting to us. But valuations are good, but not great. And so when we think about how the market's been trading lately, with it being really focused on how the Fed is going to play things out, where inflation is going to settle out, I think there's a lot of room for the markets to get ahead of themselves. And so as we think about the range of outcomes, we think that volatility is still something that markets are going to have to contend with and maybe not get ahead of themselves on some of the macro optimism that they've been demonstrating lately. So I'll stop there. Jay, I'm sure you have tons of thoughts here.
Thank you, Marta, and thank you, John. I just love the title, right? It's different this time, or why 2023 is different. We wrote a piece at TPW Advisory about 3 weeks ago saying that it's different this time. Sorry, it's not different this time are the 5 most dangerous words in finance, right? With the old cliche being, it's different this time are the 4 most dangerous words. Point being, of course it's different, right? I mean, you just touched on it, Marta, with what happened in the last couple of years. We're coming out of a 100-year pandemic. We have the first land conflict in Europe in 80 years. We have the most aggressive rate tightening cycle in 40 years, and we have unprecedented climate change. So of course it's different. And I think that's right off the top, something that we really have to embrace as investors. And so like you, we'll take a little bit of a step back and look at 2022. And the way we approached it, we'll go back to mid-year. And we, with our focus on the tripolar world, as John touched on, we identified 3 keys to the second half of the year. The first was the pace of energy price declines in Europe. The second was the path of decline of US inflation. And the third was the potential for China to move off of zero COVID. And so those were kind of our 3 signposts that we watched last year. And then they were great to help us get involved in certain segments of the markets. So again, writing weekly, as John pointed out, I wrote a piece in October saying things I don't understand, right? That was the title, Things I Don't Understand. And the first exhibit was why European financial asset prices had not responded to the halving of energy prices in Europe over the course of last fall. And of course, we know it was just a matter of time ultimately, right? And I went back just the other week to take a look at the performance, and lo and behold, European banks, which is a position we've been in for a while and continue to like, are up 35% from that weekly musing, from the date of that musing, versus ACWI up about 12. So I think where I may differ a little bit, Marta, from you is I think we're a little bit more sanguine on the potential for stability, right? So our big tagline has been 2022's headwinds are turning into 2023's tailwinds. You think about inflation, rate spikes, central bank aggressive tightening, strong dollar. We would argue that we're in the early phases of all of those things shifting to tailwinds. And as that happens, we expect volatility in financial asset prices to decline. So when you look at the VIX, for example, we expect it to be much more around 20 and below rather than the elevated 20s and low 30s of last year. The MOVE index for the Treasury market peaked at 160 last fall. it just was under 100 over the last week or so. We think bonds have gotten ahead of themselves, but the point being volatility of financial assets should ebb, much as macro volatility should ebb. And we're really focused on the dollar. We think the dollar holds the key here. And so we believe dollar weakness will continue as the rest of the world starts to grow. We see a desynchronized global economy where the central banks of Europe and the United States are tightening. The economies are slowing. Central banks are withdrawing liquidity. However, in Asia, it's the opposite. Central banks are flat to easing, providing significant liquidity, right? Both the PBOC and the BOJ of China and Japan, respectively, adding significant liquidity to the global markets. And those economies are starting to grow. So we see a desynchronized global economy, the beginnings of a new global growth cycle led by Asia and supported by central banks cutting rates in 2023, not raising rates, particularly led by emerging market banks. So we're
Hey, Jay, let me jump in there real quick. We don't want to give everybody everything here to start. I just wanted to quickly just jump over to Barry here. You know, Barry, there's a lot that's been said there, right? You guys work with individual clients. As advisors listening to this right now, what are the notes that they should be taking down? What are the things that they should be touching base with their clients? Where do you think the fears sit there as they go through all these different scenarios that could play out in the markets?
Oh, do you really want to ask me that? Nobody ever likes my answer to that, which is as an individual investor, not a trader, not an institutional investor, not somebody that's judged quarterly, but as people who have married their portfolio to a financial plan. All this stuff is fascinating, but as individuals, you shouldn't let it affect your perspective on thinking about putting capital at risk for the long term by buying various asset classes. Nobody wants to hear another lecture about the advantages of low-cost passive. That's the core of the portfolio. I think what Robert and Marta are talking about for our clients is really interesting for the satellite portion of their portfolio, which is, all right, if your core is long-term and, you know, I know everybody says 70-30 or 60-40 is dead. We don't believe so. Maybe you might like this at this part of the cycle, a little bit of a value tilt on the equity side. Last year, we shortened up our duration in the beginning of the year, and that seemed to have been pretty useful for us. But for around the edges, if you want to try and juice your returns, you know, we've had, to what Robert has suggested, we have had in excess of a decade of outperformance of US over developed ex-US, especially Europe, and emerging markets. So if you want to look at this and say, hey, mean reversion is an eventuality, and you want to put some money to work in the satellite portion of your portfolio, hey, a little European exposure, a little emerging market exposure, on the assumption that the US can outperform 2 and 3 decades in a row. Historically, we've seen that go back and forth. I think for the individual, that's a useful way to contextualize that. I'm also in Marta's camp. We didn't see the war coming, just as we didn't see the pandemic coming. We care less about valuation because we're buying the entire market. And our perspective of valuation is more along the lines of valuation expands and contracts over the course of a market cycle, which can run, 10, 15, 20 years. I looked at 2022, not as the end of the bull cycle, which we date back to 2013, but just as another example of mean reversion. Hey, over that decade, you had the markets, the previous decade to 2022, US equity markets were up 14% average annual versus your historical average of 8%. That clearly is unsustainable. And so this reset not only brought valuations down to the, let's call it the middle of the range, but it also took a little bit of that excess out and acknowledged that that zero rate environment is going away. And so
Barry, can I
I'm
stop you there?
go ahead.
If we're going to talk about a zero rate environment, right? The Fed and inflation, this has been garnering headlines for probably the past 15 months now. So this feels like another great jumping off spot for the three of you guys to get into a conversation here. You know, what do we see the Fed doing, you know, over the rest of 2023 into 2024, right? I think inflation was a little bit higher than people sort of expected yesterday, not much. So what are we supposed to make of that right now as we move out of this zero interest rate environment? And either one of you or anyone, feel free to jump in and take that one to get started. Again, we want to have a conversation here.
Listen, I'll give some thoughts real quick on that, but I caveat any thoughts I have on forecasting inflation and forecasting Fed with there should be a huge confidence interval around, you know, kind of any of those estimates that I'm throwing out. But just if we're speaking about the mentality of the Federal Reserve, and we think about the fact that in 2020, Jay Powell announced average inflation targeting program. So basically this idea where we're not going to push inflation to 2%, but we're going to allow it to float a little bit and give it some upside momentum. And that made some sense, right? As we were in a period of heavy deflation. And then we get the pandemic and we see inflation rally and the Federal Reserve first says it's transitory. I think there's a few signals there that if we put the Fed at net neutral, they're more dovish than not. They want, you know, to get out of the way. And so I think there's a lot of expectation that the Fed will do just that. And last year, I think the markets were caught off guard by how aggressive the Fed ended up being and how far it pushed, you know, kind of record setting or precedent setting kind of moves in the Fed funds rate. So I think as we're thinking about this, we're not necessarily trying to prognosticate exactly what the Fed is going to do, but we're looking for what the market isn't necessarily pricing in and what kind of protection do we have in our portfolios. And so right now, I know this is shifting in real time, but right now it seems as though the market is expecting the Fed to kind of let loose a little bit and relax a little bit. And I think what we're asking ourselves, if inflation isn't as responsive as people are assuming, that it just has this gravitational pull back to 2% nice and easily, how will the Fed respond? And is there a chance that the Fed pushes harder than people like? And so that's the kind of consideration that we have when we look at equities. Our valuations really accounting for that. When we look at fixed income, do we see some protection there? And if we look at the two side by side, I think we think the income protection in fixed income is far better than it was a year ago. We think the reward for risk might be a bit stronger than maybe in equities, where our models are saying broad brush, US equities still seem like they're maybe a little bit below fair value. So maybe a little bit more risk in the equation on that side. It's just one consideration as we look at markets. And again, I think there's a huge confidence interval around inflation and around Fed expectations, but that's some of the debates that we're having internally here.
Gentlemen, thoughts from you guys?
Yeah, I mean, I'll just pick up on that and say that, you know, we've been believers in kind of the middle way or the middle path between high inflation and deep recession for most of 2022. And certainly in 2023. So we anticipate the Fed going on pause in the near term, perhaps as soon as the next meeting. And we do not expect rate cuts as the market is pricing in for late this year, given our view of no recession. What we do think that means is that it limits the upside of the US equity market. So to Barry's point earlier, which I was beginning to make, we really favor the non-US markets, and we see a US market, like I think Marta's describing, of kind of a flattish plus or minus 5–10% return, given lack of valuation support, given starting multiples, given the likelihood of rates staying higher for longer. But what's interesting is that's actually the best environment for non-US equities to do well. Right? Because we've all been in the game long enough to know when the US goes up, people don't care about the rest of the world. When the US goes down, everything goes down. So we see this coupled with a weak dollar as really the springboards for what we believe is going to be a secular change in relative performance favoring non-US equity, both DM and EM versus the US.
But just on this point of US versus non-US, it feels like it would be such a sea change if we did see that shift of non-US outperformance. Now, for the record, we are overweight non-US, and we've done so to our detriment for quite some time. But I don't know, Barry, if you have insight on this, but we have so many investors who have a very strong home bias that has been reinforced over and over again over the past decade. And so I do see more and more people growing interested in non-US based on the relative valuation arguments and some of the concerns here at home. But it'd be interesting to see how advisors and investors actually respond should we see a shift in the performance differential between the two.
Really interesting. It's funny you mentioned the home country bias. Not only is that endemic throughout the world, but we also have a tendency to see people invest regionally with a home state bias. So if you're in the East Coast, you tend to have a heavier finance and telecom weighting. If you're on the West Coast, you tend to have a heavier technology and software weighting. In the Midwest, you have a heavier industrial and agricultural weighting, which if you think about it, if your local economy is tied to that particular industry, if anything, you want to go the opposite way and say, hey, I live in New York City. I work in New York City. I have a massive exposure to the finance industry, which is, usually second or first biggest industry in the region. But we tend to go the other way. We like companies whose CEOs we're familiar with. We like industries that we're familiar with locally. And, that works until it stops working. It tends to lead to a little bit of an overconcentration. Think about the US as, what percentage of the global market cap? About 45%, and about 20-something% of the global economy. And yet the average American's investment is, their equity portion is probably 70-80% US biased. The caveat to that is, hey, about half of S&P 500 revenues come from overseas, so we're exposed even if we're heavily invested in the US. But still, that tends to be what we end up seeing, which is just a wild overexposure to local country, local city and state as well.
Yeah,
With
when you
that-
take that and
go ahead, Jay.
make it to the tech, you add it to the US, kind of tech weighting being so much of the S&P, that's going to, in our view, be the anchor. It's been the engine for US
That's
equity outperformance. We think it's going to be the anchor because we don't see rates coming down a lot. And the rest of the world is much more cyclically exposed, which plays into the idea of a new global growth cycle.
That's right. I mean, if you were to strip out big tech out of the US market over the past 10 years, you would not see the same performance that you see looking at the broad market. It has been definitely the fuel to the US market.
And it was actually the signal to start thinking about offshore, because if you ran a S&P versus equal weighted, right? I mean, we're big believers in ETFs. We use only ETFs in our model portfolios. And so there is an equal weighted S&P ETF, which has been knocking the socks off of the SPY over the last year, maybe even longer. So that was actually the tell that then led us into non-US. And like you, Marta, we're significantly overweight non-US.
No, Jay, be curious.
Go ahead, Marta, and then I'm gonna.
Okay,
go
so
ahead.
real quick.
No worries.
I know you've mentioned interest in Europe. We're overweight non-US, but it's really targeted. So I would say Germany is a position, it's pretty cyclical. It looks cheap to us. We have some exposure to UK, European financials, China, but it's not broad-based. So I'd be curious how you're assessing opportunity in Europe.
Yeah, we've been bullish Europe and overweight Europe last year, primarily through the banks, as I mentioned, and also a EFA, so Europe and Asia value ETF. And so we've maintained those positions. And what we've been adding to over the last 3 or 4 months is Asia, and in particular, the emerging market part of Asia. So we like Japan, we like China, we like Southeast Asia. We like and own Brazil and Mexico in Latin America. And so that's really our EM play. And we're overweight EM, both debt and equity, as well as overweight EFA versus the US. So we have a pretty dramatic, dramatic being like we're benchmarked to ACWI in our equity weighting, and US makes up 60% or so of equity of ACWI, and we've got about a 40% allocation on a relative basis.
So quick question for Jay and everybody else. How do you get exposure to China in a way that's fair for US investors? If we look at the MSCI index for China going back to 94, if you're a domestic investor, you did fine in China. But if you're a US investor, not so great. How do you pick around the fact that it seems to be a bifurcated system that doesn't treat foreign investors especially well?
So is that differential due to currency movement, Barry?
No, it has to do with the way China treats outside
Share
investors.
classes.
Yeah, the different share classes, and you're definitely a second-class citizen coming from the US investing with China. They have a tendency to want to do things certain ways for their own investors, and everybody else is back of the line.
I mean, I don't really share that view, but I would say that we we own KWeb, which is the exposure to China tech, which trades at a fraction of US tech and has had a rocket move off the bottom. Once China exited zero COVID, it was time to get long, and long pretty much all risk assets, because it right away took out the risk of global recession. And it meant it was just the first of several moves. The first being exiting zero COVID, the second being ending the regulatory crackdown on big tech, the third being the removal of the 3 red lines against the China property developers, and the fourth being the ending and sidelining of the wolf warrior diplomats who had been running the kind of the foreign policy show for the last couple of years. So we think China's made a major structural and pragmatic move to go for growth because they have to, right? The deal that China makes is, we grow, our citizens are happy, and there's no real issue around politics. Once that goes away, the growth side, that's a problem. So we own KWeb, we own the FXI. We want to have domestic exposure. So our focus is on technology, which is very cheap on a global basis. So we have very little US tech. We have a lot of China tech. And then we want domestic exposure because we believe, much like the US and Europe, China has excess savings of several $1 trillion that they're going to spend over the next 1 to 2 years. And they would like to reorient their economy away from fixed asset investing, away from exports to domestic consumption. So FXI has the biggest domestic consumption exposure of the main China ETFs, and that's why we chose that.
So with that, guys, I promised our audience that I would try to get to their questions as they came in, and we've gone far from the Fed all the way to China already in quite a bit of time here. But we had our first question come in about 10 minutes ago, so I want to thank anonymous attendee who sent this in, but they asked, how does the debt ceiling play a part in monetary policy? The Fed can't keep rates up for long, considering the interest expense on the national debt is going to double this year. So again, I don't know who wants to jump in there and take that one, but again, thank you to anonymous attendee for sending in that question. And as a reminder to everyone else, please do send your questions in. I'll do a better job of jumping in and asking our panelists today, but who wants to take that one to get us started?
I mean, it's such an easy question. I know we're all jumping at it.
Yeah.
I mean, I'll take a crack at it. I don't see the debt ceiling as being an issue. It's going to be resolved. If anything, it's an overhang on the dollar. It's an overhang on U.S. assets, and it reflects the fact that the U.S. has plenty of issues, and political dysfunction is front and center relative to the other major regions of the world, where there is much less of that, certainly in Europe, as well as in Asia, I would argue.
Yeah, I would just add that we haven't spent a ton of time analyzing the debt ceiling. Of course, we'll be watching how things play out. You can always look at the 2011 scenario and watch how markets responded to that stretch. And from what I recall, rates crashed a bit, and we're in a different period now. And so we'd have to take a look at kind of what happened then and what the forces are at play now to think of how they play out. But I mean, there is this long-term question of U.S. debt and what that means. And I don't know if that's necessarily an immediate question that we're wrestling with, but it is something that I think, as we think of a longer-term outlook, it's something that we have to toy around with a bit. Barry, I think you were about to say something. Sorry for cutting you off.
So first on the 2011 scenario, I have a very vivid recollection of S&P downgrading U.S. debt on concerns about the debt ceiling, and immediately the U.S. cost of borrowing capital went down. The bond market said, yeah, U.S. is still, money good. We're not worried about that. The other issue that's kind of amusing, anytime deficits, debt ceiling, anytime that stuff comes up, I have been hearing about this bullshit my entire adult life, and everything we have been warned about. If you do this, no one will lend to Uncle Sam. The cost of capital is going to go up dramatically. The dollar is going to crash. We're just coming off the strongest period of the US dollar in our lifetimes. It's literally been half a century of the Puritans warning about the debt. Never when the Puritans are in office. It's always when someone else is controlling the White House or someone else is controlling the Senate or the House. It's used as a political cudgel. And if you haven't figured out that this is just a nonsense game, then you just haven't been paying attention. P.S. Japan's debt to GDP ratio is 2.5 times that of the U.S., and their economy is fine. Their ability to borrow money is fine. Their debt rating is fine. So one day, maybe our lifetimes, maybe our kids' lifetimes, the deficit's going to matter. But so far, it's been literally half a century of the boy who cried wolf.
It's such an
One
interesting
thing that
question.
I would add too is
Jay, hold on one second. Let Marta had started, but
Oh, sorry, just real quick on that point. I think one thing that it really is a wrinkle in the analysis, I guess, is that it's a relative game. And Barry's talking about Japan's debt levels, and when global investors are allocating capital, they're looking in one country relative to another. We're not operating in isolation, and I think that changes the analysis in a way that maybe kind of a back of the envelope calculation wouldn't lead you to think. Sorry, go ahead, Jay.
No, that's a very good point. I think it's one of the reasons why we think the dollar is probably going to weaken, because foreign capital is maxed out on U.S. assets. And, once Japan starts to provide a yield that's interesting, then we can expect domestic Japanese investors to start buying Japan and not buying the U.S. treasuries. And it's also calls into question the wisdom of trying to force U.S. investors to not own China. Just imagine what happens to the treasury market if the Chinese decide they want to sell all their treasuries. The other point I just wanted to make was that, it's kind of like past the parcel, right? Because one of the reasons why we don't expect a recession is that there are no major imbalances in the U.S. economy, right? The U.S. consumer is fine, record low unemployment. U.S. corporates are flush with money, trillions of dollars of capital, returning stock at a record rate, and banks are fine. So yeah, we've kind of transferred the debt issue of 08 and 09 to the federal government, but the government can deal with that through inflation And I do think we're going to have a high nominal growth world with a little bit more inflation and maybe some financial repression to deal with that interest expense, which I do think is going to be a political question, if not a market question.
Hey,
So we've got another-
before we move on,
Sure.
John, I just have to say, does anyone really expect China to dump $1 trillion worth of U.S. treasuries on the market? And second, there is a shortage of high quality sovereign bonds. There'd be a little bit of disruption if they, threw a couple $100 billion or maybe even $1 trillion. But I think it wouldn't take all that long for that wobble to settle down, and those treasuries would find a home. I think the threat of China's, detonating the $1 trillion bond atomic bomb, I'm not sure if there's a whole lot of real damage there. It would definitely be disruptive, but I think the markets have the ability to figure out how to manage that.
I was kind of being somewhat tongue in cheek, Barry. I don't expect it as well, but I do think, we're playing a somewhat dangerous game by having the government tell us where we can invest our money, which is increasingly the case in the US, though we're supposed to be the land of free enterprise. And China does have the ability to take and buy other things. They're buying gold, for example. China was a massive buyer of gold, the central banks. And we do see Japan already, Japan financial institutions selling treasuries at, not $1 trillion, but I think it was 50 billion in the last month that they've sold to go back into Japan. So yeah, at the margin, I do think there would be a problem for the treasury. Rates would go higher, right? Do I expect them to dump $1 trillion? No, I was being somewhat
Right. But by the way, I love the trade we made. Here, we're going to print up some paper and give it to you, along with an IOU, a note that you're going to send us all this high quality manufactured goods. Our printing presses are fairly inexpensive to run, and so far, again, after half a century of all the warnings we've heard about doing that, there hasn't been any real downside. If China wants to scrape some metal,
Donald Trump.
Well, before we start getting too political here, guys, we do have a lot of questions from the audience.
So does anyone really think the deficit is Trump ran as a deficit crusader? That wasn't why he got elected. Is a lot of reasons why he managed to just barely thread the needle by 100,000 votes out of 100 million cast in because of the Electoral College and running against a very unattractive candidate. But if China wants to scrape metal out of the ground and pay to store it somewhere, hey, let them do that. I would rather put money to work in more productive uses. Gold, it looks nice on your wedding band or on a watch, but it's not really a useful way to deploy capital. And I'll take all the hate on Twitter on that. I was a gold investor in the mid 2000s when GLD came out. I've been a lot less enthusiastic about gold when the economy is structured the way it's been over the past decade.
So guys, I did again make a promise to the audience we would try to get their questions answered. So we're running out of time. We only have about 8 minutes left. So I want to try to see if we can get to these two questions and then maybe do a quick little speed round on some different topics with some short 30-second answers. So question again comes in from anonymous attendee. So thank you again to them. But you guys have talked a lot of game on international exposure. Could you argue that the USD global reserve currency status will continue to favor our markets here in the US over everywhere else? Compare our stock market cap versus international exchanges. So I guess the question is, as US as that kind of reserve currency, is that what gives us the edge going forward? And Marta, you were quiet for a bit while these two guys went back and forth. So why don't you take that one?
Yeah, first of all, I just, when it comes to currency, I think it's important to know that there's a lot of different factors that's going to drive the way currency behaves. The kind of health of the economy, obviously the health of other economies, And I think how established the US dollar is, how established the US economy is, I think that does give us an edge to a certain extent, especially when you see global concerns come to the fore, and you watch the way the dollar behaves, you watch the way treasuries behave. So I certainly think there's some structural advantages at the moment to the US dollar, to the US economy. But I don't, just kind of taking it to kind of from a positioning standpoint, from an opportunity standpoint in portfolios today, my argument today is that the US dollar is pretty overvalued based on kind of its movements over the past year and based on where other currencies are today. So for us, that it kind of underlines or underscores the opportunity outside the US in terms of other currencies. But yeah, sure, I think there are some structural advantages to the USD.
All right, so let's try to do a quick sort of speed round here with people giving sort of 30-second answers. So are there opportunities to invest in climate change or climate change opportunities? Someone is asking.
Yes, 100%. We run a TPW 20 thematic model portfolio, which has 40% in climate, ranging from EV to nuclear to hydro to carbon to solar and wind. So absolutely.
All right.
Real
What
quick.
about healthcare? Oh, go ahead, Marta. Yeah,
No. Just one quick point. I think one of the ways that we've looked at climate change and all the associated developments that come with it is on traditional energy stocks. And so we still see some areas of opportunity in those traditional areas, European energy, MLPs here at home. So just quick shout out on that.
Thank you. The other one here is healthcare. Barry, I'll throw that one to you. Thoughts on healthcare? Is there opportunity for investment in healthcare?
I have no real insight into that space at all.
There we go. Fair enough. Marta, Jay, thoughts on healthcare?
Nothing here.
Yeah, we sold it about 2 or 3 months ago to get more aggressive.
You sold out of healthcare?
Yes.
All right. So group not too constructive on that. Cybersecurity. Thoughts on cybersecurity?
I'm in favor of it.
Oh, and what about investing in it then, Barry?
It's a tough space to invest in. There's a handful of ETFs out there. It seems to ebb and flow every time there's a high profile hack, no pun intended, for the ETF. Again, we're not thematic investors, we're allocators. So we tend to not think about that. This is something I would tell you to throw to Jay.
Yeah, I mean, cyber is definitely a part of the thematic space, and that whole space got killed last year. So one of the arguments we make is that as we see a return of macro and financial asset stability, we would expect some of those spaces to do much better. And the cyber side is one of those spaces that has room to grow, but it's a long-term position. The thematic space, as we've seen in the last couple of years, one has to be ready for a long-term buy and hold.
Gotcha. So Marta, excuse me, I know when you and I talked to get ready for this, excuse me, we talked a little bit about big tech. I know it kind of came up when we talked about the S&P and its weighting in there. Sort of, are you constructive, not constructive on big tech? Sort of, where are your thoughts there?
Yeah, so I will say that big tech was a big thorn in our side for a long time. We did not have tons of exposure to big tech, and it was a drag on our performance. We maintained that last year. It helped us last year. Going forward, as we look at these different companies, to us, it's not so much a rising tide lifting all the big tech boats. It's a little bit more opportunity by opportunity. So today we're interested in communication services. We started adding communication services last year. And so that's home to some of, the old telecom, but it's also home to Meta and Alphabet and Netflix and Disney and some of these companies that just got crushed last year. And so we think the expectations are off relative to kind of where we see digital advertising going and some of the trends there. So communication services has a place in our portfolios, but some of these other areas, IT, consumer discretionary, which is where some of these other big tech names fall, they're not rising to the fore for us. And so if we think that we are in something of a regime change and we think that inflation is a bit higher, we think rates are a bit higher, some of the advantages that those companies have maybe aren't quite as strong as they used to be. Oh,
I was muted there, so I can say real quickly, why don't we run around with, obviously you can't anything macro without at least bringing up crypto. So maybe there's a thumbs up, thumbs down here with a minute to go. But Jay, thoughts on crypto?
Out of it.
Barry?
I have a small position, but not worth talking about personally. You're buying a call option on a possible technology. Maybe it works out, maybe it goes to zero. It's an absolutely speculative crapshoot.
Gotcha. Marta?
Yeah, I haven't played around with crypto. Our investment team hasn't. One thing, I think it's speculative, and I think crypto has a way of being really ideological, and we like to be, kind of analysis driven. So that's harder for us to make a call on that.
So no crypto zealots here, which is fine. So that's bringing us up right against our 50 minutes. Huge thank you to Marta, to Jay, to Barry. A very special thank you to our audience, to those who submitted questions. If we didn't get to your question, our apologies. We'll do our best to get you a fuller answer, but remember, you will get emailed a replay of today's webcast. It will live on our YouTube channel, which is Future Proof. Just search Future Proof in YouTube and you'll find us there.